Perhaps you know that you should live within your means, buy and hold some investments for the long term, and secure proper insurance coverage. However, you can't bring yourself to do these things. Everyone knows how difficult it is to break habits that have been practiced for many years. The temptation to spend money lurks everywhere you turn. Ads show attractive and popular people enjoying an exotic vacation and a new home. A variety of personal and emotional hurdles can get in the way of making the best financial moves. As we discussed earlier in this course, a lack of financial knowledge, which stems from a lack of personal financial education, can stand in the way of making good decisions. In this course, Getting Started with Personal Finance, we examine where people learn about finances and helps you decide whether your current level of knowledge is holding you back. You can find out how to improve your financial literacy and take responsibility for your finances, putting you in charge and reducing your anxiety about money. After you understand the basic concepts and know where to buy the best financial products when you need them, you'll soon see that managing personal finances well is not much more difficult than other things you do regularly, like tying your shoelaces and getting to work each day. Regardless of your income, you can make your dollars stretch farther if you practice good financial habits and avoid mistakes. In fact, the lower your income, the more important it is that you make the most of your income and savings, because you don't have the luxury of falling back on your next big paycheck to bail you out. More and more industries are subject to global competition, so you need to be on your financial toes now more than ever. Job security is waning, layoffs and retraining for new jobs are increasing. Putting in 30 years for one company and retiring with a gold watch and lifetime pension are becoming as rare as never having problems with your computer. Speaking of company pensions, odds are increasing that you work for an employer that has you save toward your own retirement instead of providing a pension for you. Not only do you need to save the money, but you must also decide how to invest it. Personal finance involves much more than managing and investing money. It also includes making all the pieces of your financial life fit together. It means lifting yourself out of financial illiteracy. Like planning a vacation, managing your personal finances means forming a plan for making the best use of your limited time and dollars. Intelligent personal financial strategies have little to do with your gender, ethnicity, or marital status. All people need to manage their finances wisely. Some aspects of financial management become more or less important at different points in your life, but for the most part, the principles remain the same for everyone. Knowing the right answers isn't enough. You have to practice good financial habits just as you practice other good habits, such as brushing your teeth or eating a healthy diet and getting some exercise. Don't be overwhelmed. As you watch this course, make a short list of your financial marching orders and then start working away. Throughout this course, we highlight ways you can overcome temptations and keep control of your money, rather than let your emotions and money rule you. What you do with your money is a quite personal and confidential matter. In this course, we try to provide guidance that can keep you in sound financial health. You don't have to take it all, pick what works best for you and understand the pros and cons of your options. But from this day forward, please don't make the easily avoidable mistakes, or overlook the sound strategies that we discuss throughout this course. How financially healthy are you? When was the last time you reviewed your overall financial situation, including analyzing your spending, savings, future goals, and insurance? If you're like most people, either you've never done this exercise or you did so too long ago. This section guides you through a financial physical to help you detect problems with your current financial health. But don't dwell on your problems. View them for what they are, opportunities to improve your financial situation. In fact, the more areas you can identify that stand to benefit from improvement, the greater the potential you may have to build real wealth and accomplish your financial and personal goals. Financial problems, like many medical problems, are best detected early. And as with your personal health, the best problems are those avoided. Clean living is a good thing, right? Here are the common personal financial problems you need to know. Number 1, not planning. Most of us procrastinate. That's why we have deadlines and deadline extensions. Unfortunately, you may have no explicit deadlines with your personal finances. You can allow your credit card debt to accumulate, or you can leave your savings sitting in lousy investments for years. You can pay higher taxes, leave gaps in your retirement and insurance coverage, and overpay for financial products. Of course, planning your finances isn't as much fun as planning a vacation, but doing the former can help you take more of the latter. Number 2, overspending. Simple arithmetic helps you determine that savings are the difference between what you earn and what you spend, assuming that you're not spending more than you're earning. To increase your savings, you either have to work more, increase your earning power through education or job advancement, get to know a wealthy family who wants to leave its fortune to you, or spend less. For most people, especially over the short term, the thrifty approach is the key to building savings and wealth. Number 3. Buying with consumer credit. Even with the benefit of today's relatively low interest rates, carrying a balance month to month on your credit card or buying a car on credit means that even more of your future earnings are going to be earmarked for debt repayment. Buying on credit encourages you to spend more than you can really afford. Number 4. Delaying saving for retirement. Most folks say that they want to retire by their mid-60s or sooner. But to accomplish this goal, they need to save a reasonable chunk, around 10% of their income starting sooner rather than later. The longer you wait to start saving for retirement, the harder reaching your goal will be. And you'll pay much more in taxes to boot if you don't take advantage of the tax benefits of investing through particular retirement accounts. Number 5. Falling prey to pressure. Steer clear of people who pressure you to make decisions, promise you high investment returns, and lack the proper training and experience to help you. Supposed great deals that can't wait for a little reflection or a second opinion are often disasters waiting to happen. A sucker may be born every minute, but a slick salesperson is pitching something every second. Number 6. Not doing your homework. To get the best deal, shop around, read reviews, and get advice from objective third parties. You also need to check references and track records so you don't hire incompetent, self-serving, or fraudulent financial advisors. Number 7. Making decisions based on emotion. You're most vulnerable to making the wrong moves financially after a major life change, a job loss, divorce, or death in the family, for example, or when you feel the pressure. Maybe your investments plunged in value. Or perhaps a recent divorce has you fearing that you won't be able to afford to retire when you planned, so you pour thousands of dollars into some newfangled financial product. Take your time and keep your emotions out of the picture. Number 8. Not separating the wheat from the chaff. In any field in which you're not an expert, you are at risk of following the advice of someone you think is an expert, but really isn't. Number 9. Exposing yourself to catastrophic risk. You're vulnerable if you and your family don't have insurance to pay for financially devastating losses. In the worst cases, folks without a savings reserve and a support network can end up homeless. Many people lack sufficient insurance coverage to replace their income. Don't wait for a tragedy to strike to find out whether you have the right insurance coverage. Number 10. Focusing too much on money. Placing too much emphasis on making and saving money can warp your perspective on what's important in life. Money is not the first, or even second priority in happy people's lives. Your health, relationships with family and friends, career satisfaction, and fulfilling interests are more significant. That's not to say that it's okay to ignore or give insufficient attention to your personal finances and associated decisions. Your financial net worth is an important barometer of your monetary health. Your net worth indicates your capacity to accomplish major financial goals, such as buying a home, retiring, and withstanding unexpected expenses or loss of income. Your net worth is your financial assets minus your financial liabilities. Financial assets, financial liabilities equals net worth. The following sections explain how to determine those numbers. A financial asset is real money or an investment you can convert into your favorite currency that you can use to buy things now or in the future. Financial assets generally include the money you have in bank accounts, stocks, bonds, mutual funds, and exchange-traded funds. Money that you have in retirement accounts, including those with your employer, and the value of any businesses or real estate that you own are also counted. Assets can also include your future expected Social Security benefits and pension payments, if your employer has such a plan. These assets are usually quoted in dollars per month, rather than as a lump sum value. To arrive at your financial net worth, you must subtract your financial liabilities from your assets. Liabilities include loans and debts outstanding, such as student loans, credit cards, and auto loan debts. When figuring your liabilities, include money you borrowed from family and friends, unless you're not expected to pay it back. Include mortgage debt on your home as a liability only if you include the value of your home in your asset list. Be sure to also include debt owed on other real estates, no matter what, because you count the value of investment real estate as an asset. Your net worth is important and useful only to you and your unique situation and goals. What seems like a lot of money to a person with a simple lifestyle may seem like a pittance to a person with high expectations and a desire for an opulent lifestyle. Getting rid of your debts, the highest interest rate ones first, is the most important thing. Then you want to build a safety reserve equal to 3 to 6 months of living expenses. Your overall plan should involve getting out of debt, reducing your spending, and developing tax-wise ways to save and invest your future earnings. Here are the most important actions that you can take to boost your attractiveness to lenders. Number 1. Get all 3 of your credit reports, and be sure each is accurate. Correct errors and be especially sure to get accounts removed from your credit report if they aren't yours, and show late payments or are in a collection. Number 2. Ask to have any late or missed payments that are more than 7 years old removed. Ditto for bankruptcy that occurred more than 10 years ago. Number 3. Pay all your bills on time. To ensure on-time payments, sign up for automatic bill payment, a service that most companies, like phone and utility providers, offer. Number 4. Be loyal if it doesn't cost you. The older your open loan accounts are, the better your credit rating will be. Closing old accounts and opening a bunch of new ones generally lowers your credit score. But don't be loyal if it costs you. Number 5. Limit your debt and debt accounts. The more loans, especially consumer loans, that you hold and the higher the balances, the lower your credit score will be. That said, your credit score will generally be maximized if you aren't using more than about 30% of your credit limits. Number 6. Work to pay down consumer revolving debt, such as credit card debt. If you obtain your credit report and find a blemish on it that you don't recognize as being your mistake or fault, do not assume that the information is correct. Credit reporting bureaus and the creditors who report credit information to these bureaus often make errors. Number 1. If the credit problem is someone else's. A surprising number of personal credit report glitches are the result of someone else's negative information getting on your credit report. If the bad information on your report is completely foreign looking to you, contact the credit bureau, by phone or online, and explain that you need more information because you don't recognize the creditor. Number 2. If the creditor made a mistake. Creditors make mistakes, too. You need to write or call the creditor to get it to correct the erroneous information that is sent to the credit bureau. Phoning the creditor first usually works best. The credit bureau should be able to tell you how to reach the creditor if you don't know how. If necessary, follow up with a letter or email to document and provide a record of your request. You may not know or care, but you probably have a personal credit report and a credit score. Lenders examine your credit report and score before granting you a loan or credit line. This section highlights what you need to know about your credit score and reports, including how to obtain them and how to improve them. A credit report contains information such as, number 1, personal identifying information, includes your name, address, social security number, and so on. Number 2, record of credit accounts, details when each account was opened, the latest balance, your payment history, and so on. Number 3, bankruptcy filings, indicates whether you filed bankruptcy in recent years. Number 4, inquiries, lists who has accessed your credit report because you applied for credit. Your credit score, which is not the same as your credit report, is a 3-digit score based on the report. Lenders use your credit score as a predictor of your likelihood of defaulting on repaying your borrowings. As such, your credit score has a major impact on whether a lender is willing to extend you a particular loan and at what interest rate. Given the importance of your personal credit report, you may be pleased to know that federal law entitles you to receive a free copy of your credit report annually from each of the 3 credit bureaus, Equifax, Experian, and TransUnion. Instead of simply throwing money into buying your credit scores or paying for some ongoing monitoring service to which you may not give much attention, take an interest in improving your credit standing and score. Working to boost your credit rating is especially worthwhile if you know that your credit report contains detrimental information. Why do you borrow money? Usually, you borrow money because you don't have enough to buy something you want or need, like a college education. You'll be able to take many more vacations during your lifetime if you save the cash in advance. If you get into the habit of borrowing and paying all the associated interest for vacations, cars, clothing, and other consumer items, you'll spend more of your future income paying back the debt and interest, leaving you with less money for your other goals. The relatively high interest rates that banks and other lenders charge for bad consumer debt is one of the reasons you're less able to save money when using such debt. Not only does money borrowed through credit cards, auto loans, and other types of consumer loans carry a relatively high interest rate, but it also isn't tax deductible. Calculating how much debt you have relative to your annual income is a useful way to size up your debt load. Ignore, for now, good debt, the loans you may owe on real estate, a business, an education, and so on. As with good food, you can get too much of a good thing, including good debt. When you incur debt for investment purposes, to buy real estate, for small business, even your education, you hope to see a positive return on your invested dollars. But some real estate investments don't work out. Some small businesses crash and burn, and some educational degrees and programs don't help in the way that some people hope they will. There's no magic formula for determining when you have too much good debt. In extreme cases, we've seen entrepreneurs, for example, borrow up to their eyeballs to get a business off the ground. Sometimes this works, and they end up financially rewarded, but in most cases, extreme borrowing doesn't. Here are 3 important questions to ponder and discuss with your loved ones about the seemingly good debt you're taking on. Number 1. Are you and your loved ones able to sleep well at night and function well during the day, free from great worry about how you're going to meet next month's expenses? Number 2, are the likely rewards worth the risk that the borrowing entails? Number 3, are you and your loved ones financially able to save what you'd like to work toward your goals? When you charge on a credit card that does not have an outstanding balance carried over from the prior month, you typically have several weeks, known as the grace period, from the date of the charge to the time when you must pay your bill. This is called playing the float. Had you paid for this purchase by cash or check, you would have had to shell out your money sooner. How much money have you actually saved in the past year? By that, we mean the amount of new money you've added to your nest egg, stash, or whatever you like to call it. Most people don't know or have only a vague idea of the rate at which they're saving money. The answer may sober, terrify, or pleasantly surprise you. In order to calculate your savings over the past year, you need to calculate your net worth as of today and as of 1 year ago. The amount you actually saved over the past year is equal to the change in your net worth over the past year. In other words, your net worth today minus your net worth from 1 year ago. We know it may be a pain to find statements showing what your investments were worth a year ago, but bear with me. It's a useful exercise. If you own your home, ignore this in the calculations. However, you can consider the extra payments you make to pay off your mortgage principal faster as new savings. And don't include personal property and consumer goods, such as your car, computer, clothing, and so on, with your assets. How much do you save in a typical month? Get out the statements for accounts you contribute to or save money monthly. It doesn't matter if you're saving money in a retirement account that you can't access. Money is money. Regardless of how much or how little money you have invested in banks, mutual funds, brokerage, or other types of accounts, you want to invest your money in the wisest way possible. Knowing the rights and wrongs of investing is vital to your long-term financial well-being. Few people have so much extra money that they can afford major or frequent investing mistakes. Answering yes or no to the following questions can help you determine how much time you need to focus on investing. Number 1, do you understand the investments you currently hold? Number 2, is the money that you'd need to tap in the event of a short-term emergency in an investment, where the principal does not fluctuate in value? Number 3, do you know what marginal income tax bracket, combined federal and state, you're in, and do you factor that in when choosing investments? Number 4, for money outside of retirement accounts, do you understand how these investments produce income and gains, and whether these types of investments make the most sense from the standpoint of your tax situation? Number 5, do you have your money in different diversified investments that aren't dependent on one or a few securities or one type of investment, that is, bonds, stocks, real estate, and so on? Number 6, is the money that you're going to need for a major expenditure in the next few years invested in conservative investments rather than in riskier investments such as stocks? Number 7, is the money that you have earmarked for longer-term purposes, more than 5 years, invested to produce returns that are likely to stay ahead of inflation? Number 8, if you currently invest in or plan to invest in individual stocks, do you understand how to evaluate a stock, including reviewing the company's balance sheet, income statement, competitive position, price-earnings ratio versus its peer group, and so on? Number 9, if you work with a financial advisor, do you understand what that person is recommending that you do? Are you comfortable with those actions and that advisor, and is that person compensated in a way that minimizes potential conflicts of interest in the strategies and investments he recommends? Making and saving money are not guarantees of financial success, rather, they're prerequisites. If you don't know how to choose sound investments that meet your needs, you'll likely end up throwing money away, which leads to the same end result as never having earned and saved it in the first place. Worse still, you won't be able to derive any enjoyment from spending the lost money on things that you perhaps need or want. In this section, you have to deal with the prickly subject of protecting your assets and yourself with insurance. The following questions help you get started. Answer yes or no for each question. Number 1, do you understand the individual coverages, protection types, and amounts of each insurance policy you have? Number 2, does your current insurance protection make sense given your current financial situation, as opposed to your situation when you bought the policies? Number 3, if you wouldn't be able to make it financially without your income, do you have adequate long-term disability insurance coverage? Number 4, if you have family members who are dependent on your continued income, do you have adequate life insurance coverage to replace your income if you die? Number 5, do you know when it makes sense to buy insurance through fee-for-service advisors and companies that sell directly to the public, bypassing agents, and when it doesn't? Number 6, do you carry enough liability insurance on your home, car, including umbrella excess liability, and business to protect all your assets? Number 7, Have you recently, in the last year or two, shopped around for the best price on your insurance policies? Number 8. Do you know whether your insurance companies have good track records when it comes to paying claims and keeping customers satisfied? If you answered no more than once or twice, don't feel bad. 9 out of 10 people make significant mistakes when buying insurance.